This.
Um, we're on live now. Hello, everyone. Good evening. Good evening. Good evening. Y'all come on. Y'all come on. We have some special stuff for you this evening. We have some stuff. So, Armand, this is how we're gonna start. So, Armand is our special guest tonight. And Armand, I want you to tell us a little bit about yourself. I'm gonna back us up just a little bit. Hold on. And how long you been in the business and all that good stuff. They waiting on you, Armand. They coming on. Hello, y'all. Hello, hello. I see y'all coming on. We got a wonderful set for y'all today. I'm going to introduce to you Armand Knows. He's the lender that I work with exclusively at Dupree Realty Group. And he's got so many other people he works with. So I'm going to allow you guys to learn from him tonight. Pick his head, pick his brain. He tired, y'all. He is a straight comedian. So, so just go ahead and pick his brain. All right, Armand, tell us about yourself.
My name is Armand Knowles. I have been in the industry since 2008. For the last 5 years, I have been a star producer for Homestar Financial. I am based out of Yay! I am based out of Cartersville, Georgia, but my area covers or encompasses all of Georgia. So wherever you are, if you're within the city, or if you're within the state limits of Georgia, I got you covered.
Woo! That's what's up. Now,
Yeah.
did you say y'all are also in Alabama too? Like some other states you guys are in, aren't you?
So yeah, Homestar itself is all the touching states. So it's Tennessee, Alabama, South Carolina, North Carolina, Florida. So we have those there. I don't lend in those counties, but my office does.
Okay.
Well, those
Okay.
states, but my office does. If not, I have branch managers that can do it. But we can lend in any state that is touching, and we can go out further. I just don't know exactly what all states we're licensed in.
Okay. Awesome, Armand. So tell us about your background a little bit. You're married, you have children.
I've been married to my wife Shamira since 2007. I just had a birthday yesterday,
Woo
so
woo!
yeah, I
Happy
have.
birthday!
Thank you, thank you. I have two kids. I have a son, Jalen. He's 20. He's in college, attending the Fort Valley State University.
Ah, boo.
Yeah, yeah. My pay, they killing me down there at Fort Valley. And then I have my daughter Hayden. She is 7, and she is in second grade.
Awesome, awesome. So you killing the game over there at Homestar. Did you say you were a superstar for how many years in a row?
No, just I'm a star producer. This will be my 4th year that
Okay.
I've been there. Yeah. So, but I've been at the company 5. So,
Okay, awesome. Wonderful. Well, I'm trying to make sure we can get everybody's comments, Armand. They are on
okay.
here, and for some reason, I can't see people's comments. But anyway, so just tell us a little bit about the mortgage industry. The title of our message tonight is Are You Ready to Be a Homeowner from a Mortgage Perspective? So
Okay.
just talk to us and tell us what it's going to take. And I'm sure they're going to have questions for you, and then we can go from there.
Yeah, the main thing, I love questions. I love answering questions. So is now the right time? So back it up. Last year around this time, we had the uncertainty of COVID. So everyone started being afraid of COVID. Myself, I was one that was wondering, where am I going to be going with this home buying industry because of COVID? Everything due to COVID, is everything going to shut down? It's been quite the opposite. This has been probably every loan officer's probably most productive year
Yes.
this year. So the market is on fire. Um, First time home buyers, which I know some of you guys are, I absolutely love it because you are a blank slate and I am here to teach you. So what you got to just make sure of right now is COVID did change some of the lending practices. Pre-COVID, my company, and I'm speaking for my company itself, we could do as low as a 580 credit score. We are now exclusively at a 620. But what is great with the lending person that you get is that I want to take your 620 and I want to make it a 640 just because it's going to be an easier loan for you. There are companies that can give you a 580 credit score, but right now with those companies, they're going to charge you discount points, which are fees that the lender's going to be charging that's not going to benefit you. So when you're hearing you can go to 580, if it's not me, it's another company, make sure that 580, find out what it's going to cost you to get that 580. And if the lender is good enough, they can get you from a 580 to a 620, 640, 660. It could be in a matter of 30 days. So what the process of what happens is that you're going to give me a call. We're going to speak on the phone, and I'm going to get a little bit of detailed information from you. I'm going to ask you your name, your social, your date of birth, your address, kind of where you work. We're gonna get all that in. We're gonna pull your credit. That is going to be the key thing that determines what you can purchase. So your credit. I don't know, Alicia, do you want me to get detail or just okay?
Detail. We need it.
Detail. Okay, so once I pull your credit and I've looked at your income, I'm going to determine what you can afford by what I find on your credit and what your income is. We're going to come up with ratios. We have two ratios that we look for. We're going to have your front ratio, which is going to be your housing ratio. We're going to have your back ratio, which is your debt ratio. The difference between the two is your front ratio is we're going to take your total income, meaning before taxes, everything. So if you're making $4,000 a month, we're going to use $4,000, not what you're going to get taxed. So your front rate, your housing ratio, it can vary, and that all depends on your credit. But let's just go industry. Let's just go standard. You can get up to about 35 to 40% of your gross income for your housing ratio. So we'll take the $4,000, and you're going to hit that you're going to multiply that by 40%. That's going to be what you can really afford on a house. Now, your debt ratio is going to be the same factor. We can go up a little bit higher, but we're going to take your housing, your proposed housing payment, along with all the debts that's going to be found on your credit report. That can go as high as a 56.9%. But I always caution people to try to keep it under 50 just to keep it safe. But depending on the times, if we're going FHA, we can go up to a 56.9. Conventional, we got to keep it at about a 50% because they will not let you go any higher than 50%. And then there are going to be other loans.
Okay, let me stop you right there, Armand. 50%. So conventional, they base your ratios off of 50% of what you make.
Correct. Period.
Okay. But FHA,
yes, FHA is a government-backed loan. They give you a little bit more leeway. They will allow you to go up to 56.9% is the highest that I've gotten approved.
Okay.
Now, I don't know if you have a lot of VA people, but
I do.
So VA doesn't care about ratios. They only care about residual income. That's the difference. So the veterans loan, which is the VA, so all you veterans out there, appreciate you. But so what the veterans do is 100% financing. There's no mortgage insurance, and they go by what we call residual income. What residual income and how it differs is we'll plug in. VA wants you to make sure that all your bills are taken care of and you have leftover money, which is your residual income. So they're going to account what you're going to be paying in taxes, so all your taxes are going to come out. If you have child care, that's going to come out of your residual income. And long as you have X amount left over, depending on your family size, you can go to VA. So for instance, I had a person with a 65% back ratio, which is unheard of, but I got them approved VA because they still had residual income left. So they paid out all their bills. They still had $700 or $800. After they paid every one of their bills, VA will let us write that loan.
Now, were they considering how much it would cost for this new mortgage?
Yes.
Did they still have $700 left
yes.
after they? Okay. Gotcha.
After the new mortgage, after they have to do maintenance. So we have to calculate a proposed maintenance plan. All your taxes are being taken out. Everything that is going to encompass, if you can make that mortgage payment, we've already considered that. And as long as you have that leftover money, you'll be good to go.
Okay. Go ahead.
The big thing right now is student loans. And I can go all day about student loans. Student loans are calculated different depending on the program that you choose. So if I'm going FHA and your student loans are deferred, and the government tells you that you are on COVID relief, you don't have to make payments, we as a lender still going to count 1% of your total balance. If you owe $100,000, we are going to count $1,000 against you as a fictional payment. That is FHA's guidelines. The beauty of it is if we go conventional now is if you're on an IDR or an IDR, so that is an income-based repayment plan or income-driven repayment plan, depending on which one. And Alicia, let's say your income repayment plan is 0, and we're going conventional and we're good. So guess what your payment is for your student loans?
0.
We can use that. That is my saving grace with student loans right now. Or if you pull if I pull a credit report and your student loans has $100,000, but your payment is $200 and it's on your credit report and they're reporting at $200, we can use that with conventional. FHA, we still have to default to the 1% because it's the highest. Now, VA is also great if you were the VA loan and your student loans are deferred out for 2 years, or actually it's a year, I can still count 0 because it's deferred. If it's not deferred, we can use 0.5% on VA. Also, we can use it as 0.5% on conventional. Mm-hmm. So those are, and it's also 0.5% on USDA as well. Okay. So FHA is the one that hits you the hardest with those payments. And what they found is we used to allow, if you defer them out for 2 years, we were good. Or we were putting you on 25-year extended standard plans. So companies caught up, they said that people weren't actually on those loans. So they go back and they audit these loans and they'll start seeing, hey, well, these student loans are becoming a factor. So that is why we have to calculate student loans the way that we do. So if they're telling you that you're deferred out or you have to make a payment because of COVID, if you're going FHA, we're still going to count a payment against you. So be prepared.
Wow. Yes. So let me ask you this question. If you have student loans that are actually in collections or you have some late payments, how does that affect you from becoming a homeowner?
So if they're in collections, if you get an approval with conventional, you'll be okay with them being in collections with conventional. But the other side of it, you're not going to get an approval with conventional with student loans and collections. So student loans, if they're government backed, which most of them are, because you have some private ones that they can be in collections, you'll be okay. But if you're with Navient, Federal student loans, one of those guys that you're in collections, behind the scenes, we pull this thing called CAVERS. CAVERS is just a tool that we pull to make sure that you don't have any in debt to the federal government. So what they'll do is they're going to flag your CAVERS issue and say that, no, you have a CAVERS hold. And until we get those student loans out of collection, you can't get a government-backed loan. So that's going to be your FHAs, your USDAs, your VAs, until we get that student loan from out of collections. Typically, what I've noticed with collections of student loans, they'll put you in a program. It'll take you about 7 or 8 months before they will release those back to your regular credit report versus being in your collection and put into your positive credit.
So a person will have to wait for 7 to 8 months in order to move forward.
And now, if you get them if you figure out a way to get them out of collections quicker, and you clear your CAVERS, you're okay. But what I have noticed, and it's just happened, is that I had a person that has like 7 or 8 of them that are in collections. It's going to take them, the company told them they got to make between, I think it's 7 or 9 payments before they will remove those out of collections.
Wow. Mm-hmm. Wow. So this is good stuff. So, because everybody got student loans. And so people need to know before they start looking for a house, whether they're mortgage ready or not.
Correct. Okay. And also, the other thing that you want to do is that I've always cautioned people to get credit. Like, don't get Credit Karma. Credit Karma is not always the best tool, of giving you your credit score, but it's a great tool. Because what'll happen is you'll go and you'll put your student loans in a deferred program. Now, the student loan will take you out of a deferred program and they'll start hitting you with lates and you have no idea. So you always want to kind of keep a monitor of your credit report to make sure that if your student loans are in deferment, they're staying in deferment and they're not coming out, because they'll come out and in 60 days, by the time that you know or you get a letter, you have 60-day rolling lates on your credit report, and it's absolutely killing your credit.
Wow. Yes.
So
Okay.
stay on top of them. Stay on top of them.
So let me ask you this question, Armand. This was a question that came up yesterday for the audience. And a gentleman said that he had his own business, and he also had a job. And due to COVID, his job, the type of job that he had transferred. So now he's driving for Amazon, and he's a driver versus what he did before. Will that keep him from becoming a homeowner because the type of job has changed?
So what was he doing before?
Gosh, I think he said, "Ooh, I'm trying to remember."
You can give me a scenario. Okay, so the way that it works, if he's a driver and he's with Amazon and he's getting what we're looking for. In the past, I've noticed that it used to be that you want to kind of stay in the same line, and that's still true in a sense. So if he was, let's say he was a warehouse worker, right? He's working in a factory, and that factory shut down, and now he's driving for Amazon, and Amazon is paying him an hourly rate to drive, and he's doing 40 hours a week. He would still be okay. Now, where it gets difficult is if he was doing warehouse work and he started driving for, let's say, one of these trucking companies, and they're paying him by the mile or by the load, then that becomes a 1099 job, and that becomes something we have to calculate over a 2-year span, versus if you're getting steady 40 hours a week, this is what you're getting paid.
That's exactly what happened to him. He was a W-2 employee, and now he's a 1099 employee working with those two companies. 2 years. Amazon. Yeah, 2 years.
2 years.
So
because
he has to wait 2 years?
He has to wait 2 years. Because what happens when you're 1099? 1099 is a self-employment. That's basically what that means. You're self-employed. So we have to see a 2-year history of your self-employment, because your first year, you can come out making $100,000 a year. And the next year you can make $30,000. We have to, at that point, do a 2-year average. So the moment that you go 1099 is the moment you got to wait 2 years.
Okay.
Now let's flip that. Let's say that you were 1099 you were 1099 for 2 years, 3 years. You were 1099, and you was like, nope, this self-employment stuff is not here. I'm gonna go get a job doing something else, and you were there 6-7 months. We could then use that, because we can calculate your income, because you're now saying you're making $30 an hour at 40 hours a week. We can calculate that income. So we would be able to still write that loan a little bit quicker if you went from self-employment to regular employment. Yes. Okay.
W-2 to 1099.
W-2 to 1099 is a 2-year wait. 1099 and W-2 can pretty much be done in a quicker manner.
Okay. Okay. Cool. So what if you always, and this is for our self-employment audience, what if you've always been self-employed and you went and got a job, a W-2 job, for maybe like a year or so? Does that hinder you?
Yeah. No, you would be able to buy.
Okay.
Because that's like what I was saying. So when you go back into the W-2 side of it, we can calculate that income. We see the real income there. We know that you're making, this is your hour, this is what you're making per hour, this is the hours you're working, this is your income. On 1099, they basically can say, I had a gentleman, he made $140,000 a year. But when it was time to get to his taxes, he wrote off $141,000 a year.
Yeah.
So his income is negative $1,000. But we know he makes the money, but he writes it off. So we have to see a 2-year history of you actually showing income. So self-employment, my self-employment borrowers, they're going to want to see you making that. So you're going to have to pay taxes.
Oh, so in his case, he has to wait two more years before he can buy?
If he went from W-2 to self-employment, yes.
Because he wrote off 141,000. So
that guy did. So that guy, he's going to stay self-employed. So in his case, he's been doing it for so long. If you've been self-employed for at least 5 years in the same line of work, 5 years, let's say you work for the same company for 5 years and you've been self-employed, or you've had the same business for 5 years, if you've done it for 5 years, I can do 1 year in tax returns. But within that 1 year, you have to show income.
Right. So what if you did not show income and you go back and amend your taxes?
You need to amend them before you go see a mortgage professional. We do not. If you're going to amend them, you need to call them and tell them that you're going to amend them, and they can okay, you're going to amend them. But before you submit a loan application, get your taxes amended first, because what's going to happen is if I start an application and turn this into my underwriter, they're going to see that you got to amend it. They're going to say you're just getting them amended to purchase a home. And so if I see it, I can't tell you to amend your taxes, because I can't tell you, oh, just amend your taxes to get approved. But if you get them amended before you come to me, we will accept amended tax returns.
Okay.
And another way is if you're doing it and you owe the IRS, right? Because my self-employment people, they may owe $20,000, $10,000, $15,000, right? Set yourself up on an IRS payment plan. We take those as well. So if you have that and you're in the process of getting a mortgage, get with the IRS, set yourself up a payment plan. We'll just count that against your debt ratio. So now you don't have to come up with all of this money. You might just saying, okay, I owe $30,000, but they're going to let me pay $300 a month. Well, you claim that income. Now we're going to just take that $300 from your debt to income ratio, and you can get approved that way as well.
Wow. Okay. So one question is, let's say I'll give you a scenario. How much money do you have to be making to get a $250,000 house?
It's not about the money that you make. It's about how much debt that you have. So you can make so for a 250, I'm gonna pull my, so you put me on the spot right there. Yeah, I'm gonna pull. So at $250,000, we're gonna say that payment's gonna run $1,300, give or take, depending on taxes. We'll just use $1,300 as a baseline, right?
Okay.
So we're gonna use $4,000 a month, which is about 48 grand a year. All right. So if you take that 4,000, and like I said, we're gonna go with the highest. We're gonna be going FHA. We're gonna say that's a 56.9%. You could afford a $2,276 debt ratio payment on $48,000. So you can afford it at $48,000. But now let's say that you at $48,000, you got a $600 car payment, you got student loans. You got to make more money to do it. So it's not, those questions are hard because it really depends on your debt. It's not really you have to make this amount, but the person can make $100,000, but they got $200,000 in student loan debt and a $50,000 car. Well, that person at 48 is going to look a lot more attractive with no debt than the person at 100 with a lot of debt. So it all depends on your debt to income ratio when calculating how much you can afford.
Okay. So it sounds like you're saying before you get ready to fill out your application, you want to try to pay as much as your debt down as possible, correct?
When you put your application in, you let us determine. I always caution to let us kind of determine what you need to pay off. I've had people that pay off collections because someone said, go pay off all your collections. You're going to come to me, I can pull your credit, and it's like, yeah, don't pay that off, because it's a collection and because you pay off doesn't necessarily mean it's going to improve your credit.
Good.
I might look at it and tell you, hey, you have Comcast, you have Verizon, you have this. Everyone has hiccups in the past, right? And that could cost $2,000. You're like, well, I'm going to pay this $2,000. Well, I'm going to pull into mine. I have a what if simulator A what if simulator basically tells me if you pay this, what is it going to do to your credit? 9 times out of 10, you're going to be paying that stuff and it's going to do absolutely nothing for your credit. So you've given out $2,000 thinking it's going to improve your credit because they've told you as a debt collector, oh, pay this off, it's going to improve your credit. No, let us determine and tell you what you need to pay off.
Wow. That's
I'm here to
stuff.
I'm here to save you money. I would rather you save $2,000 and you can worry about that debt later. You can settle it after you get into your home. I'd rather you be able to take that $2,000 and put it towards your down payment, put it towards upgrades in your home, put it towards other things versus an old debt that is not going to benefit you.
Wow. That's good stuff, Armand. Next question, Armand. What about what do you call it? Down payment assistance programs currently in Georgia. What's the advantage of them? What's the disadvantage of them?
Now, I will tell you, I am not a big DPA lender. I know enough. So right now, Georgia Dream is the one that blankets all of Georgia, right? So Georgia Dream, to me, it's a great program. It can be somewhat updated just because, as you know, the prices of homes have skyrocketed. So if you're in the medical profession, which is, or what they call the service professions, police officers, teachers, firemen, nurses, anything that's in the service profession, they'll give you $7,500. The standard Georgia Dream program is $5,000. They did have a program in some disaster areas that has gone away, and they were given $15,000. That was the best DPA going. The only thing that's hard about it is, you said the average house is what you think, 200,000 right now?
250 in Atlanta.
So 250. Well, Georgia Dream is giving you 5,000, but it's going to cost you 5,000 just in fees.
Really?
Because lenders are going to charge you 2% origination, 2% of 250. You're already at $5,000, and you still have your other fees that you have to concern yourself with. So the other kicker is if you sell, refinance, or just flat out you come into money and you pay it off, it's what Georgia Dream is attached as a silent second. Meaning you're going to get your mortgage statement every month. You're not going to see it. You're going to forget about it. But then you're going to refinance it. You're going to sell it. And they're going to say, wait, well, you got to pay this silent second. So now you only got, in some cases, they might give you $5,000. You actually were able to use $1,000. Well, you got to pay them back the $5,000. They're going to come. Is that
like a statute of limitations? Is that within 2 years?
No, period.
Just because you sell, period.
Period. If you get a Georgia Dream regular standard, the $15,000 was forgiven after 5 years. But if you get a standard FHA loan or even a service one, you got to pay it back.
Dang.
I just did one for a friend of mine that is a teacher. He did it about, I would say, 10 years ago, and he refinanced to an amazing rate, but he had to pay his Georgia Dream off at $7,500, and it was 10 years ago. Now, you will have people tell you that it's forgiven, and that was always a misconception that was forgiven. It wasn't. The city of Atlanta has a really, really good grant. So the city of Atlanta has it's the housing authority. It's the housing authority grant for the city of Atlanta. You don't have to be in the housing authority to get it. It's just, you can go up to $250,000. It's got a lot of requirements, which I could go over with a person if they qualified within the city limits, but they give you up to $20,000. And if you stay in the house for 10 years, it's forgiven.
But the thing is, you have to live within the city limits of Atlanta. And when you think about great neighborhoods, that's Alpharetta, which is now you're gonna go outside of the requirements because the houses are gonna be more expensive.
Right, and it's got to be the city. It can't be Alpharetta. It can't be College Park. It has to be the city limits.
City of Atlanta.
Period.
That's a crack house. Oh, sorry. Okay.
So that's what I was saying. A lot of these programs have to kind of catch up because the housing market has boomed. And they started off as Georgia Dream. To me, 7, 8, 9 years ago, you could find a house for $80,000, $90,000.
Right.
Now you find it, and investors are buying them up, or they're not going to be livable. So you kind of stuck, and they'll go up to a max of 250. And I mean, that's becoming the starting point for the new homeowners that are out there.
Okay, Armand. So now I've got some people on here that are ready to purchase. They're actually going to be on what we call a 6 months challenge, and they're ready to purchase. Now, what do you suggest that they put in savings for down payment, closing costs, and earnest money? What should they be expecting to pay, and how much do you think they need to put aside if they're going to get that standard house that we talked about, $40,000 a year, 250,000?
48. I'll say 48. That's rough. So again, there's not just one standard way that you can calculate. So what I'll tell you is that we're just going to use FHA as the base, because that kind of blankets everything. So FHA, you're going to need 3.5% down. I mean, that's just going to be period 3.5%. Now, closing costs, and you can probably touch upon that with them, because closing costs are going to be depending on, you're not going to go in and a house is going to come on the market the first day, and you go in, it's like, I'm going to give you $250, I need $6,000 in closing costs. They're going to tell you, well, this other one told me
this other offer
is going to say, I'm going to give you your full price and no closing costs.
Yes.
So the way that everything is broken down, so they'll know you have 3 different parts to a mortgage, or what we look at. You're going to have your down payment. That's going to either range from 3 for conventional. Conventional, you can go 3, 5. Anything past 3, you can go in increments. It could be 3, 5, 10, 15, 20, whatever you want to bring. So the minimum we're going to do is 3%. FHA is 3.5. So you have your down payment. You're then going to have your closing costs. Your closing costs are going to be what my company charges, which is going to be $1,295, period. I don't care if your house is $80,000 to $400,000. We're going to charge you $1,295, period. So you're going to have your closing costs, and it's going to be our costs, the attorney's fees, title work, all of that stuff. And then you're also going to have your prepaids. Your prepaids are going to be taxes and your insurance, and that's how we're going to get your escrow going, meaning your escrow is going to be an account that's going to be held, and they pay your taxes and your insurance. So at the end of the year, when Fulton County sends you a county or a city bill and saying your taxes are $3,000 and you freak out, no, your escrow has already paid that. They're just sending you that bill to have it. So when you're out looking, if you're going to be aggressive, you're going to have to pay your closing costs, your prepaids, and your down payment. So you're going to have about 3.5% there. Depending on the time of the year, it could be $6,000 to $7,000 for your closing costs and your prepaids. Could be lower. It just depends on when you purchase.
Wow.
And now, if your credit score is strong, you won't need reserves. Reserves are only going to be there to strengthen your file. A score at 700 probably will not care if you have reserves. A score at 620, you might have to have 2 months in reserves. What reserves are going to be additional funds that is going to be sitting in an account for an emergency purpose. So if your payment on your house is $1,200 and they need 2 months in reserves, we're going to need about $2,400 outside of your down payment, just sitting in an account. It could be your 401k. It could be a Roth IRA. It could be anything that can become liquid if we need it. So that's what reserves, that's how you calculate what your reserves are going to be. Now, because I'm asking to tell you that you need reserves, doesn't mean that when you're closing, you have to spend that money in reserves. We just have it sitting in an account.
Wow. Okay. Now that opposes another question. When people, because I've had this to happen, people were under contract and they got disqualified because of the way their money was being deposited into their account. The underwriter couldn't find, how do you say it? The underwriter couldn't find proof of this particular income. Is there something you suggest to the people to be careful of that will probably put them out of pocket in purchasing a home as it relates to going to the underwriting process?
So what I've had right now and I've been dealing with is I had two people, they were friends and they're cut from the same cloth. And they have what we call mattress money. And that is where they don't really believe in putting them. They were taught not to put money into the bank, lump sums, so they keep it at home. So when it's time for them to purchase, they would have had, like, you got $1,000 in the bank, and then all of a sudden there's a large deposit of $5,000 or $6,000. If you have cash and you put $5,000 or $6,000 into your account, and I see it, or an underwriter sees it, that is useless money. We cannot use it at all. Now, if you're going FHA and you put that money into the bank and it sat for 30 days, and by the time that you get to me, I pull it, I don't care where the money came from, because you've already had it and it's seasoned into your account. You cannot drop it. You cannot just drop cash into an account. Now, in some cases, you can get away with it. We have a rule where you can go up to 1% of your loan amount. So let's say if it's $250,000 and you put $2,200 into it, well, that's less than 1%. We can use that cash, but an underwriter is going to look at it and they're going to see that you've had. They want to make sure that you've had payments of $2,500 before, and it's a consistent amount for you. Because what people are doing is they'll say, okay, my down payment is $5,000. How can I get it? They'll go to a buy here, pay here thing. They'll go get money from someone. They'll do it, and we can't source that money. And if we can't source it, we can't use it. Now, not to say that if you go get money from a family member, as long as that family member has the money in their account, let me stress this. You cannot take your cash and give it to your mom, and then your mom say, oh, it's coming from me. Because we're going to want to see mom's bank account as well. And if mom had $38 in the account, and now all of a sudden she has $5,000, she cannot give you that money as a gift.
Wow.
Now, because we're just going to follow the money. Now, if mom decided she wanted to go out and she took a loan to give you the money, we don't care if mom took a loan. As long as we see where the money is coming into her account and where it came from, she can give it to you, because we deem it as a gift anyway. So we don't care what happens on mom's side. She's not my borrower. She's got to deal with the credit companies. We're concerned about you. But you cannot just drop cash into your account. That has been the main thing that's getting people, is that they'll just put cash into an account.
Yes, I've had that happen, was under contract, and it just exploded everything. And I just had to comfort that person because they were crying.
Yes.
So another question that I believe the audience is going to have, and okay, so for those who have IRA accounts or retirement accounts, and they want to take that money out to use towards their down payment, what can they do?
Well, you said, what can they do?
Yeah, can they do that?
Yeah, yeah.
Okay.
You can pull your 401k typically will, if you're purchasing a house, they have a thing called terms of withdrawal, and they'll give you certain terms. So if you're buying your house and it's your first house, they will actually, without penalty, let you pull your money from your 401k.
Okay.
And we can use that all day.
I had a client, and I believe because she had a 401b, I think, she couldn't take it out.
Teacher?
Yeah.
No. So teachers my wife's a teacher. So what teachers have is the 401bs or the TRS, is the teacher retirement accounts. So what they do is you can't pull that till you're 65, period. So you could have $300,000 into that account. We can't even use it at all, because we know until you turn the age of 65, that money is not being pulled out.
Wow.
I know that firsthand, as my wife's been teaching for 8 years, and my mother-in-law has retired teaching. And so I kind of see how she was able to navigate and at her age, how you can pull it. But no, you cannot, as a teacher, you can't count that income. You can't count it as reserves. It is just an account that we know that you may have it, but you can't pull from it.
So the best thing is that they make sure they have money put aside for their down
Yes,
payment system and everything, and don't try to depend on other outside resources.
correct. Unless you're outside resources, if you have a family member, and when I say family member, not your cousins, brother, your sister, your aunt, your uncle, it kind of stops at cousins. If they're willing to gift you the money, they just have to show where they had the ability from their bank account to give you the money, and you can't accept a gift.
Okay, let's talk about bankruptcies.
Okay.
How old do bankruptcies have to be in order to be approved?
So it's a really good question. So you have your standard two types. You have your Chapter 7 and your Chapter 13. Your Chapter 7 is where you completely wipe out all of your debts. So it's a couple of ways that can go. If you had a house if you had a house and then you included into your Chapter 7 bankruptcy, you got to wait 3 years. If you did not have a house and you just do your standard Chapter 7, it is 2 years, and these are all from your discharge dates. So with a Chapter 7, it's about a 4-month process from the beginning. So we wait to that discharge date. And from that discharge date, we count up 2 years and you're able to purchase. Now, if you include a mortgage, you got to wait 3 years.
Okay.
Chapter 13, you actually can purchase a home while you're in your Chapter 13 bankruptcy.
Okay.
What you have to do is we got to count, because you typically going to have a payment on Chapter 13 because you're paying that money back. So you're going to have a payment that you're paying back to your trustee. You have to get approval from your bankruptcy trustee to purchase, refinance a property. So if it's a purchase, if your trustee gives you written approval and you qualify with the payment that you're paying to pay back your creditors, and your trustee gives you that letter, you can actually buy while you're in a Chapter 13. Because a Chapter 13, depending on what you could take you 4, 5, 6, 7 years to pay it back. So we're not going to penalize you for that long. You just got to get the approval from the trustee, and it is business as usual.
Wow, this is good. So, like in my situation, that bankruptcy was 4 years. I think I had to wait, right?
No, it's gonna be 3. Well, I don't know. I'm not getting into your business, but it's not. It's gonna be 4 if you're going conventional.
Okay.
So
see, that's good.
Yes.
I'm glad you said that, because most people don't know those little fine prints. Okay.
So conventional, if you just a flat bankruptcy, it's 4. Now, if you include a mortgage, it's 7 on a conventional. So conventional at 4 years from that discharge date, you're eligible for another conventional mortgage.
Oh, this is good stuff. You are a wealth of information. Because I was because see, some other lenders, they may say, oh, you can go ahead and get approved in 2 years, but it also depends on the type of loan you have, whether it's an FHA, conventional, or even the USD loans. I don't know about those. But
yes, USDA. Typically, all of them the rule of thumb is 2 years.
Okay.
Now, if you have like FHA is good. If you have a circumstance, we actually can still lend a little bit early depending on your circumstance. So let's say you come and you had cancer, and before that you were working, everything was fine, and you had cancer, and you were going through chemo, all that stuff, and you couldn't work. You had to file bankruptcy for medical stuff, and then you beat cancer and you're back at work. Well, then I can take that to an underwriter and it's like, okay, look, they had cancer. This was doing this. They fought cancer. They beat it. Here's what it is. They can look at it and say, okay, well, the circumstance of causing bankruptcy was due to cancer. It could be due to you had a major accident. Someone in you had a spouse and they passed away. I did one. I'll give you one that I did. I had a person that was his wife was. I mean, I'm just going. This is the story. His wife was murdered in the home. So it was a murder in the home. He left the home. He didn't want to. I mean, he didn't want to be there. It caused a traumatic stress. He lost the home. He had that. I took it. I mean, I hate asking the questions, but I had to get police report, and I got like the obituary and all of this stuff, and I tied it into it. he was able to actually purchase a year after because of the circumstance.
Wow. Wow.
Now, circumstance you can't say because it's got to be somebody really close. You can't say because my cousin passed away and I had stress. That's not going to work. It's got to be pretty much kids, wife, something that not even mom, kids, wife, something that's going to impact your household income. Now, I would probably still caution people to go 2 years out. That's just, you have certain circumstances that I would ask you, well, what is the circumstances behind your bankruptcy? Because if a lender is asking you that, then maybe they're trying to see if there's a way to get around it and get you into that house a little bit earlier.
Gotcha. Foreclosures.
Okay.
How soon do you have to wait for the foreclosure?
2 years from that foreclosure date. Conventional, you're gonna get around that 6-7 year mark for conventional. Conventional is difficult. So but here's the thing: if you have a foreclosure, and if you're trying to purchase within a certain amount of time, your credit score is gonna probably dictate that you go FHA anyway. So, because what conventional does is going to be different is if you're buying a house at $250,000 and you're bringing 3% and you have a 620 credit score, your mortgage insurance, which is your MI, probably is going to be $300 to $400 per month, where it might be $130 per month on the FHA. I'd have to do my calculations. But so if you're having bankruptcy and you're trying to buy within a 2 year frame, you're probably going to be going FHA anyway.
Okay, so conventional,
and that's from the foreclosure date, not because you left the house. Gotcha.
So conventional, the mortgage insurance is more expensive than it is on the FHA.
Not necessarily. So the MI on a conventional is based upon your credit score.
Gotcha.
If you have a high 700 credit score, you could be paying pennies on the dollar for mortgage insurance. Now, the other kicker with MI, if we're going to get into that part of it, is that FHA, if you're not FHA, to get rid of mortgage insurance, you have to put down a down payment of 11% and wait 10 years for mortgage insurance to go away. No matter if you bring 5% down and you have mortgage insurance on an FHA loan, it's going to be for the life of that loan. A conventional, if you have a conventional loan and you bring 20%, there is no MI. If you bring 10%, it's going to be probably half. And then once you get 20% of equity, or you get 20% of equity, or you pay in 20%, MI just goes away on conventional. That's the advantage of going conventional versus FHA as far as the MI factors.
Now, I know this may be a crazy question, but
shoot.
What is the advantage? What do you suggest most people go FHA? And I know maybe they circumstances, FHA, conventional, or what? We already know VA is 100%. That works for those who have been in the military.
Right.
So that's good. But when it comes to FHA and conventional, which one is better?
My opinion, it really depends on your credit score. I am I'm conventional, because conventional is gonna, even from your end, another realtor is going to take your offer seriously if you see a conventional versus an FHA. They're going to look at that conventional more so than they're going to look at that FHA.
Yeah, because they're stricter.
They're stricter, and they know that at FHA, hey, the guy down the street could be doing a 580 credit score. It could fall apart at any time. A conventional minimally is a 620 score, but unless it's just one of those where you're just desperate and they're saying we're not taking FHA offers, you wouldn't do that loan. I would kind of tell you need to go FHA. It's going to be a lot cheaper. But if you've done the part and you've gotten your credit scores up, conventional is going to be the way to go.
Yeah, gotcha. Woo, Armand, you gave us some good information. I'm gonna open it up for the audience because we got about 10 more minutes. We got to get this man to bed. He don't stay up this long. So if y'all have some questions, please let it roll. Because I tried to ask all the questions I knew that most people would ask. But if you guys have some questions, go ahead and put it in the comments, and we'll be glad to ask him.
Now I don't see comments.
I know I can't, I know you probably can't see it from your end. Or can you?
I'm trying to, let me see. Well, I'm seeing some stuff now, but okay. I don't see them pop up. I have to actually hit chat and go to comments, and you can see it that
okay.
way.
Okay, gotcha.
I can't tell you to do your own platform.
Let me see. It's so many questions I got for you. I've been trying to get you on here forever, but I think we're going to try to do this more often because it's so many scenarios that can happen to a person.
We're going to do it because I think we discussed it's going to be what, twice a month?
Yeah, I think twice a month would be good.
Y'all get to see all of my face, and I'm going to dress up the next time at 9:30 on a Wednesday night.
Yes. Armand, I really, really appreciate you. You've been around for a while.
You are most welcome. It does not. I love talking and educating people on the process because I feel if they're properly educated versus it's me versus it's someone else, it makes the experience easier. And once they kind of understand that experience, when they come to me, they come to someone else. I want it to be I want this to be a good experience for anyone that's purchasing a home. You never want to hear a horror story. You always want to hear great stories, because at that point, they can go out and tell other people, no, it's not as bad as they say. And then I also love dealing with first-time home buyers because sometimes people aren't taught this stuff, and they might not have known that. And a lot of times, it's breaking a generational. It could be something generational, and like it starts with them. They're like, okay, now I can teach this to my kids, and my kids can pass this down. My parents, I knew about this stuff, and my parents kind of taught it to me as far as buying a home, but they never told me the keys of this. I'm the first in my family to really just know this stuff. And so I'm passing that. I love to just pass this information out to others.
Yes, I can tell because you helped me out too. So let me ask you this, Armand. If people wanted to get in contact with you, what is the best way to get in contact with you?
Myself, you can email me. My cell phone number is 770-900-7762. That is a quick way to do it. You can shoot me a text. You can call. The other way is my email. It is Armand, ARMOND .Knowles, KNOWLES at homestar, F as in Frank, C as in Charlie.com. That is Armand.Knowles at homestarfc.com. Those are the quickest ways to get in contact with me. Most lenders are shut down at 7:00. I'm 7 days a week. If you need to speak to me at 7:00 at night, I'm available. And once you become a client, to me, I conduct my business different. Once you become a client, I liken it that you're employing me. So if your work schedule dictates that we speak at 7:00, and that's when you can conduct business, then I'm gonna make myself available for you at 7:00. Because without you, I don't get paid. So I'm gonna make myself available to you. I got like 7 chats. Hold on, I'm gonna see something. Okay, you got that? Got the number?
Yeah, that's me putting your stuff out. So, are you on IG? This is a social media network world. Can they follow you on IG? Can they follow you on Twitter?
You can follow. You can probably follow me, but you won't get anything from me.
Armand is old school.
No. I actually had I just kind of went away from Facebook. I'm just taking a mental break from Facebook. No, at least I had a post that went viral. In my opinion, it was shared. I think it was shared 170,000 times.
What did you say?
It was a picture, and it was a funny picture, and I made a comment, and I woke up, and next thing you know, it just blew up. So I am.
What was on the picture, Armand?
It was basically and I'll send it to you, but it was a picture of a wedding, in the
Uh-huh.
backyard, and it was a guy in cargo pants with some sunglasses and a hat, and he's sitting there with his legs crossed. So there's a circle, and there's a circle there, and I just asked, would this upset you if someone came to your wedding like this? So immediately your eyes are drawn to this guy, but in the back of it, there is, I don't know if you've seen the Avengers movies. Well, there's a Marvel character called Thanos, and there's this it's got a purple suit, the whole thing. That was a real question, but people are drawn to the circle and they don't look at the guy in the back. So when I send it to you, it'll make sense. But I thought it was going to be something simple, and it was shared like around the world, and so. I just got off social media right now. You'll be able to find me on Facebook at the beginning of the year. I was really just trying to go, just getting all this political stuff and letting everybody kind of vent about that before I got back on. But you can still find me on Messenger. So you can find my name. I'm still on Messenger. I just don't have a Facebook page. And I have a work Facebook page. You can find me on my work Facebook page. It is Armand Knowles with Homestar Financial.
Oh my God. I told you was a comedian. See, that was just your personality did that.
Yeah.
Oh my God. So listen, so we're about to get ready to head out. What would you say to your cousin that's buying a new home? What would you say that they need to prepare themselves for to become mortgage ready and to get approved?
Hey, the first thing is call a lender. And when you speak to a lender, do not try to hide anything, because I'll have people that'll try to hide information, not necessarily in a negative way, but they just don't understand the process, and they've been told, don't say this. Let your lender know everything up front, because if you don't let your lender know everything up front and we find it, I don't want you to lose earnest money. I don't want you to lose appraisal money or inspection money. Because you don't want to tell me something at the beginning to tell me, and I can tell you how to fix it or how we can get around it, could cost you up to $2,000. Let your lender know everything up front, and if it can't be done, they will let you know it can't be done. If it can be done, we will tell you how. But if you hide it, we're gonna find it, and when we find it, if it is too late, you're gonna be the one that's gonna be impacted behind it.
My God. Wait a minute. So it's Crystal, your cousin, Crystal Monique?
Yes.
What? This is a small world.
How do you know her?
I used to work at this job where she worked at.
Yeah. So her grandfather and my grandmother are brother and sister.
Wow. This is a small world, I'm telling you.
Yeah.
Man.
You done gave her the whole Facebook name. I was like, oh, you know the Facebook name. Okay. Yes, that is my cousin Chris. Yes. We've known each other our whole lives, but yes, her grandfather, my grandmother, sister, brother and sister, and they live literally 3 houses away from each other.
You know everybody I know, and I just end up finding out later. Yeah.
I know a lot of people.
I see, Armand. Okay. So that was good. Now, I wouldn't have thought you was going to say that, but most people think they can hide stuff from their lender. I'll never forget, I had a young lady under contract, and she was home buyer ready, income and everything was perfect. But what she did was she hid the foreclosure from the lender. And so when it got to underwriting stage, they found it through what y'all call CAVITs. Is that what it is?
Cavers, and they're gonna run Fraud Guard. So Fraud Guard is how you're gonna find that stuff. That's another that I'm glad you. Before we get, when people are telling you that they can repair your credit, which is fine, they can get rid of some stuff, but they cannot get rid of your student loans if you don't pay them. They can get rid of them as far as if you're buying a car, but on a mortgage, if it hadn't seasoned, we're gonna find it. We're gonna run a Cavers report. We're going to run Fraud Guard. Fraud Guard is going to let me know if you have any foreclosures or any additional properties that you own that might not be on your credit report. We will find them, and if we find them, we're going to ask you about them, and if you pop up with it, your loan's going to be dead. Just because it's not on your credit report doesn't mean we can't find it.
Yeah, I had no idea, and I felt so sorry for her because she was just crying. Like, she was so close to getting that house.
Yeah.
And the last thing, Armand, I promise this is the last thing. You know, preachers always say, I'm finna close. But the last thing, what's the difference between a pre-qual and an approval?
So pre-qualification is I'm going off of what you kind of tell me.
Mm-hmm.
Well, pre-approval is, let me go. Well, pre-approval is I'm basically just looking at your stuff, and if you tell me you make $80,000 a year, I'm gonna take it. I'm like, oh, okay. Then if you want to get fully pre-qualified, that means I've seen your information. So I can pre-approve you based off of you saying, hey, Alicia, you work at what do you get paid? You're like, hey, I'm making $20 an hour at 40 hours a week. Okay, well, you make 40 grand a year. How much money you have in the bank? I have this. I pull your credit. I was like, oh, your ratios are a 33-46. I ran through the system. You're good. Let me send you out this pre-approval letter. Now, if you want to get fully pre-qualified, I'm going to say, hey, Alicia, go ahead and send me your bank statements, your W-2s, your tax returns, depending on if we need tax returns, your bank statements. And now I have visually seen everything. Now you're going to be more so pre-qualified because I've seen it and I've verified it.
Right. That's good. Most people don't know the difference. So
yes.
I've had a lot of clients that got pre-qualified, and I hate to say the name, but I will say Quicken Loans. And then when we got to the end, they were not able to close on that house. And
guys, if you out with Quicken, they're great. The Rocket Mortgage, they are app takers. So what they do is nothing wrong with their model because that company does very, very well. But what you have to realize with them is that they're not in the business of caring about the buyer. They're in the business about numbers. So what they're going to do is they're going to look at it. They're going to say, oh, this is here. And they're going to say, you're good. At the end, when it blows up, or if it blows up, I've had it happen. I love getting Quicken Loans. I'm like, oh, I can do this all day. One going back to Quicken Loans. I had a guy that came to me. He was buying a house up in the mountains, and he was 3 days before he was closing. He said, Quicken Loans is saying now I have this foreclosure and it's a problem. And I was like, oh, they didn't tell you that when you were. He was like, no. I pulled his credit. I say, you have to wait. And it was like 4 or 5 months before it seasoned out. He was like, they didn't tell me that. I was like, no. His credit score were still in the mid, almost 700s. He had that on his credit report. They just saw that he had 700s, and they said he's fine. This dude had put up $4,000 in earnest money. He's about to lose that. I convinced because it wasn't about it. It's a log cabin up in Ellijay. And so I convinced them, it's like, hey, I can do this loan. I can give you proof that I can do this loan, but I can't do it for another 3 months. And they extended him out for 3 months, and I got him closed. So Quicken Loans. So what happens with Quicken is if something drops, if the ball drops and they can't do it, you're gonna if I mess up on a loan, which I don't, it's rare if you do, but if I mess up on a loan, you call me, you're gonna be able to find me. You can call my office, you're gonna find me. I'm gonna pick up the phone. If you go to those big companies, they pick up.
You can't find them.
You're not gonna find them. You're not gonna find John, NMLS, this, and this. John's moved on to other deals. He's not concerned about your deal, and they don't care because they're all about volume. I care about the customer. It's all about building customer relationships.
Right. That's a big difference.
Yes.
So, all right, Armand, I don't think anybody have any questions, but you have covered so much here today. I thank you so much. Is there anything you want to say with us leaving off for tonight?
Guys, do not hesitate to give me a call. You can email me. I do have my name. Type my name. You'll probably be able to find my Instagram. I have an Instagram page. I think it's aknowles22. If you want to find me on social media. If you have any additional questions and you feel comfortable texting me, calling me, give me a call and I can answer anything that you have privately. I'm willing to work and help anybody who's wanting to become a homeowner.
All right. Thank you so much. Have a wonderful night. And we'll see you.
All right.
Until then.
All right. Sounds like a plan.
All right. Bye-bye.
All right. Bye.
All right, y'all. There it is. We did mortgage ready. Are you ready for home ownership from a mortgage perspective. We just spoke with Armand Knowles. He works for HomeStar, very reputable company here in Atlanta, Georgia, and he told us a lot tonight. And he shared a lot of stuff, even some stuff that I didn't know as it relates to Quicken Loan. All I know is I had a lot of customers that were pre-approved with Quicken Loan, but at the end of the day, their loans did not go through. It's very important to know who you need to go through as it relates to a lender, because not every lender know exactly what they're doing. Not every mortgage broker knows what they're doing, because some people are new and they don't know the mechanics of your loan, and they may just see, like Armand says, 720 credit score, and they're like, yes, you approve. And then we find out later on there's some stuff on the end that was not taken care of. So you need to be in the right partnership. You need to have the right people on your team as it relates to a real estate agent, a real estate broker, and even a mortgage lender. Then you also need to understand from a perspective whether you're going to build a home or whether you're going to get a resale. So when you buy a new home, some builders will pretty much state that they will not give you closing costs if you don't use their lenders on site. So you need to understand, when you're using a builder's lender, that lender is working for the benefit of that builder. And if you're okay with that, sometimes there could be junk fees that could be added to your loan. And so you just have to have the right agent, because the right agent is going to pretty much protect you as it relates to your lending aspect, as it relates to all of the things that make up you becoming a home buyer. So he taught us a lot tonight. I didn't see any questions on here. So we'll be back soon in 2 weeks. He's going to come back for us where we can oftenly get you guys prepared, because we're running this campaign for the rest of the year. And the name of the campaign is Rise Up into Home Ownership 2021. I want to see you get your keys. We turn dreams into keys at Dupree Realty Group. That is my job, to see you receive that which you have been waiting for. Things you have never imagined to happen for you. And it has happened for so many people over the lifetime of my career. I have had the honor of walking people, partnering, being a midwife, and getting them into homes. I have gone through people who has difficult circumstances. I've actually saw them get their home. So do not be dismayed when you run through a snag. You got to have the right realtor that can walk you through that and counsel you through that, even when you come against a snag. And you also need an intercessor, because you need somebody to be able to pray you through when they say no. So I'm so excited about this new campaign, y'all. 2020, Rise Up 2020, Rise Up into Home Ownership 2021. That was Armand Knowles. He's with HomeStar. I did put inside of the chat his email address. I also put his phone number. And so if you want to reach out to him, you're welcome to reach out to him. So I can't see on here, y'all, but I think our winner from last night was Mr. Jeff, because ain't nobody else put, because we were doing a campaign. We were giving $20 gift certificate to someone who was going to be on yesterday. So we'll have more giveaways. So listen out for the giveaways. I want you to stay tuned. Stay tuned to, first of all, I want you to go and like my real estate page. It is Dupree Realty Group, and it's right here on Facebook. I want you to go like that page, because I'm going to have so much information on that page. We're going to have a home buyer seminar coming out next year, and I want you to stay tuned. And so we'll have giveaways and things for you guys so you can get ready for home ownership. I'm excited about it, y'all. And just talking to Armand, it tells you a lot of things that you need to know even before you get to that point. We talked about self-employment people. We talked about nurses. We talked about teachers. We talked about retirement income. Can you use your retirement income for a down payment? 401k, you can use your retirement income. But if you're 401b, your teacher, you cannot use it. So you're going to be prepared. I don't want no surprises coming up when you're getting ready to ask for the keys. Okay. So follow the campaign, rise up into home ownership 2021. Y'all have a wonderful evening. God bless. Thank you, Crystal, for being on. I see you.